Thank you very much. Um, I, I guess we should just go straight into the presentation itself. I've got it in front of me. I'll do my best to share it with you. So, as Stefan has mentioned, the performance has been very disappointing. So, for the full year 2021, we lagged the benchmark by a significant amount. And the end of the year, Q4, was disappointing as well. I would stress that that's not what we expect of ourselves, and it's not what our clients expect of us. So we beat ourselves up over poor performance. We continue to run through the very systematic process that we've got for investing in emerging markets. But that was a disappointing year. So even though the long-term numbers are still quite healthy relative to the benchmark and to the peer group, we're still very disappointed about what happened last year. So I'll go into a little bit of colour on what actually happened there. We kick off here with what didn't work in the portfolio, because that's obviously took precedent over what worked last year. It was mainly security selection. And we'll see as we go through exactly the areas that caused that. But the main areas of issue for the portfolio were security selection, both in China and in Brazil. We were underweight the Gulf markets, so Saudi Arabia, UAE, Qatar, and more laterally Kuwait joined the index. Those were all strong markets. And Mexico was a strong market in 2021. And again, that didn't screen well on our analysis. We had an overweight in Hong Kong, didn't work. Underweight in energy and materials, and our security selection in financials was disappointing over the period. It wasn't all negative, and in fact, for a growth manager, we beat the emerging market growth index quite significantly, but we lagged value. What did work for us was our overweight position in India and our security selection within that market. The underweight in China, Korea, and in Brazil, so the analysis at the country level worked quite well. We were zero weighted in Turkey, didn't have much impact, even though that was the weakest market in 2021. We have a small overweight in Vietnam, and that worked quite well, and the same was true of the Philippines and Thailand. Stock selection, particularly in real estate, was positive, in consumer staples and in IT. And we've got some of the names here. So Godrej is an Indian property developer with a very exciting land bank in and around Mumbai. The Indian economy held up relatively well. Valuations in the country are, on a relative basis, a little bit higher than we would like, but we continue to like that market. Max Healthcare Institute is a hospital operator in and around the Delhi metropolitan area, and they've got a nice portfolio of hospitals. They're seeing improvements in occupancy and better margins as they introduce more expensive procedures to their menu for customers. A company many of you will have heard Ian talking about, and indeed which is well known in the markets, is the Chinese battery maker Contemporary Amprex, also known as CATL. So that worked very well for us. And then what didn't work were, again, very significant names in terms of Chinese growth. So VNet is an internet and data service provider to Chinese companies. It's independent of the major platform businesses, who are the other big providers of internet services in China. US listed, and that came under a cloud because of that. Dada Nexus is an e-commerce delivery business in China. And again, this was impacted by the regulatory uncertainty. And finally, the name we want to draw your attention to was Alibaba Health Information Technology. And this is basically an online healthcare provider offering access to online doctors and pharmaceuticals. And it's actually leaning into the sorts of areas that we think the Chinese government is in favour of, but its association with Alibaba worked against it during the period. We had some changes over the year, obviously. We reduced China quite significantly, but more laterally. So the changes you see here are over the quarter. We've begun to add to China again. We're more positive on Thailand and Indonesia. So obviously we've increased the weights there. We've started to reduce exposure in India, and we've trimmed further the underweight that we had. So we've increased the underweight in Brazil. I'll show you the reasons behind that very shortly. And we have been reducing Russia as the political tensions there have started to ratchet up. So we began that before the end of the year, and we've continued it into January. Obviously very topical. And that's one of the issues that I would highlight for emerging markets, that this year political noise, and it's a bit more than noise in many cases, but certainly the influence of politics in emerging markets has come back to the fore. That remains a central part of our analysis and our ratings for the country process. So here we've got performance of the countries over the year. You can see in the left-hand chart that the two worst performing countries in the major, so the E7 shown here, were both China and Brazil. So the underweight in both of those markets was positive for performance. Russia had performed up until November. It was around then that we started cutting too. So, you know, it was still a positive relative bet to be in Russia over that period. But we've become a little bit uneasy about the continuing high level of tensions. India remains a strong market and had a very good 2021, but we sort of think that valuations are looking a bit elevated here, and we see better opportunity starting to emerge, particularly in China. On the right-hand side, you can see that Taiwan was the standout winner. We were overweight that market. We've had very strong stock selection within Taiwan. It's an area that we continue to be positive on. Surprisingly for us, South Africa did quite well. We thought in a year that saw global liquidity decrease that South Africa would struggle more than it has, but certainly its exposure to more value type businesses has been positive for that. Korea was one of the weaker markets in the E7, and you can see that Mexico again also surprised us. So there's a mixture there of positive and negatives for the portfolio performance. I won't go through all of this, but that simply is the numbers behind what we had shown earlier. At a sector level, you can see that energy on the left-hand side was a strong performing sector, and consumer discretionary was very, very weak over the period. Consumer staples went sideways. We were slightly overweight consumer staples, and our stock selection within that was very positive. Materials did reasonably well. We've been underweight materials because we've had concerns on cyclicals for most of the year, and the underweight was a detractor from performance. On the right-hand side, you can see that financial services did reasonably well. Again, a sort of value segment. You can see there that healthcare and real estate were particularly weak. Healthcare was the weakest in the fourth quarter and over the year as well. Within real estate, our exposure was concentrated in India, and that was the reason for our very strong performance there. But most encouragingly, you can see the strong performance from IT, and a lot of that came in the final quarter, and we continue to hold a very positive view on that. There's the detail. Those are the stocks that did well. We've gone through some of those, so I won't continue with it. This is the style. So in terms of how we position the portfolio, we are primarily a quality growth manager. So we look for companies that have good business opportunities to reinvest profits and continue with growth. And you can see from that we've got a positive exposure to the growth factor, and we're underweight value, and that's where you can see that most clearly in the negative dividend yield, leverage, and value bars. And that was difficult last year. Just to put it in context, the emerging market value index actually delivered a return of +4% last year, while the growth index delivered minus 8.4%. So that puts the return of the portfolio in some context. We're between the two, and that was thanks to the liquidity analysis that Simon Ward does for our team. Helped us navigate that a bit better than if we had concentrated purely on the growth factors. This kind of shows you the sort of names. These are the top purchases over the course of the year. The sorts of names that we have liked. We added to emphasis in India. It's outsourcing IT for the US market. Obviously, labour markets are tight around the world, and we're seeing a strong demand for outsourcing services for that. Alibaba, having cut that stock earlier in the year and been underweight, we think that we may be at a regulatory peak in China, and we've begun to add back to the Alibaba name. The internet names in China have fallen as a group from about a 35 times PE to just under 20. And we thought at that point that perhaps much of the negative news was priced in. These are highly profitable businesses, although the regulatory cloud remains over them, but we think it's time to start dipping a toe back there, particularly as we turn more positive on China itself. In Taiwan, Unimicron is a very highly specialized component manufacturer, and as microchip technology has become more complex, the substrate that the sort of PCB boards that they produce are at the high end of that spectrum, and they're seeing very strong demand for that. We see that continuing. In the Philippines, we added Monday Nissen, which is instant noodles. Again, a sort of interesting consumer staple. Growth in the Philippines is reasonably good. And it also has a meat replacement product, which is a high market share in the UK and offers an extra option on that. In China, we have Shanghai Baosite Software, which is a software company that helps with the digitization and optimization of steel production. And this, again, is where we try and link the portfolio with policy. No point in fighting the Fed and no point in fighting Beijing. And so in an effort to get pollution levels down, they're trying to clean up some of the dirtier industries, and Shanghai Baosite is certainly on that side. Sales, there's not a lot to say here. Most of it was reducing cyclical exposure at one point or another. Certainly with AirTac and Grupo Mexico, we were reducing cyclical exposure. Sony Optical is a camera component manufacturer, and we saw that as outlook for iPhone sales looked negative. I'll just quickly move on because I want to get to our outlook. So our outlook at the moment shows that the global liquidity backdrop is not very supportive for equity assets in general. It's fair to say that's a kind of cautious outlook for us. We expect global economic weakness to be evident in the first half of 2022 and possibly into the third quarter. Supply bottlenecks that we've seen all around different areas, and particularly semiconductors has been highlighted. Those may ease as the growth decelerates. We've also seen significant inventory increases, and as growth slows down, then we're likely to see a deceleration. Money trends are improving in China, and we think that that's very positive, and that's something that we want to lean into as we get more evidence of that. So it's just started, but that's looking positive to us. Within our unit, to find that attractive. I've already mentioned that India is attractive, but much of that is already priced in. And again, I kicked off with highlighting that the regulatory and political risks in the universe are plentiful, and that's something that we're going to have to navigate. And again, on a positive note, it would seem to us, and again, South Africa has its own clear evidence on this. It seems that COVID may be moving from a pandemic to an endemic phase. Now, that's obviously a very qualified statement. There's plenty of opportunity for new variants to come along. but it fits in with a sort of 3-year pandemic life cycle that we've seen in all over history. Some evidence behind those statements. Well, we follow real money trends, and you can see here that the real narrow money has been trickling down. You can see that with the blue line dipping into negative territory. That normally leads the real economy by 6 to 9 months. So we're expecting to see the real economy continue to weaken for the first half of 22 and now looking more likely into the third quarter. Obviously, asset markets will discount that and the end to that long before that time, but it does paint a difficult picture for the start of the year. On the right-hand chart, you see our excess money chart. So this is combining the 14 most significant economies in the globe, the real narrow money numbers for these. And typically, when the black line goes above the blue line, it becomes more difficult in terms of asset pricing. You can see that happened back at the start of 2020, and indeed that was when the growth assets started to underperform in emerging markets, certainly started to underperform the value assets, and that was part of the reason why we changed to a more cautious stance at the beginning of the year. And although our numbers are disappointing, it's why if we hadn't made those changes, they certainly would have been a lot more negative. And you can see that we're moving back into a period of negative excess liquidity, which we expect to continue. So the real narrow money, the trends there continue to be in a less than supportive direction. China is the key for us, and we're becoming more positive on that. You can see here, you can see the slowdown in nominal GDP, but in the blue line, which is true M1, and in the broader money measures, you can see that there's some signs of an improvement start to turn up. And indeed, when we look in the right chart on the banking trends, you can see that the PBOC survey loan approvals, the blue line, has certainly picked up, and the Chung Kong Goldman Sachs business survey has also started to improve. And that's not a surprise to us. Ian has said many times in the past that in most economies, the government signal to the market via interest rates and monetary policy what they would like to happen, and then the financial system slowly follows. In China, they tend to instruct the financial system what they would like to happen, and then follow through with further signals, and that appears to be the case here. The gap between E7 and G7 has closed, so it's mainly closed by G7 monetary data coming down, and E7 not picking up particularly, but as I say, it's looking good in Southeast Asia and starting to improve in China. So that's a bit more positive for emerging markets in our view versus developed markets. On the right-hand chart, you've got some detail on the individual countries, and you can see South Africa isn't particularly strong, and it had been negative for most of the year. So one of the reasons why we were cautious on that. Same is true of Brazil. This is one of the most negatives. You look at Brazil, it had been extremely and unsustainably high. So this dip back into negative territory, we're looking at 6-month rate of change. So that will moderate, but it's not looking good for the near-term outlook for the Brazilian economy as we run into an election year, which again will bring its own political risks. But I wanted to tell you, we are positive. We do have things that remain encouraged about on the portfolio, and Taiwan Tech is one of those. We see, increasing complexity in the semiconductor chain. We see strong bottlenecks in these high-end areas, and we see companies there that we think have very good prospects in terms of growing margins, in terms of reinvesting assets, and we continue to focus on those. And so at the bottom, we've listed the ones that we like. So we've got MediaTek and smartphones, exposure to Internet of Things. Aspeed is involved in server chips, and we're seeing increased investment in data centers, and we've seen that from the likes of Meta and from Google. TSMC, Unimicron, we like those in the midstream area. And downstream, we like Acton, which provides white box switches. And as we see more and more shift towards 5G and higher intensity products, that's something that we are positive about. We've become a bit more positive on financials, particularly in Southeast Asia. We see that loan growth is going to pick up in those markets. There is some inflation, but in actual fact, that will just lead to higher nominal loan growth for the banks in most of these areas. And valuations are attractive. So as interest rates rise, we think the net interest margins for the banking sector can improve. So we're selectively looking to add to those, particularly looking for the ones with strong deposit franchise, because those are the ones that actually benefit from that net interest margin improvement. We don't want the ones that are more exposed to the wholesale markets, where we've kind of targeted Korea, India, and Indonesia for those increases. And this is just a recap on the strategy. We are a bit cautious. We're turning more positive on China than we have been for some time. We think that the money growth has bottomed there even before the Evergrande default that started to improve. And as the evidence comes out, we will lean into that. The cautionary tone, I guess, around China is based on two not insignificant issues. One is their response to Omicron. They're trying to have a zero Omicron approach, and that means that they're restraining travel, certainly international travel. Internally, travel is not too bad, but as they continue to focus with that, that's kind of a restraint on the economy that we need to be conscious of. And the other issue is the regulatory clampdown that we saw last year. It seems to have moderated, and we think the focus is away from that. We're going to focus our portfolio on areas of the economy that the government is looking to support. So clean energy, the common prosperity, we think that will help with consumption plays within China. So I guess I probably should stop there and open up to questions.